GM. Today I want to talk about mental flexibility. I've talked about this in the past. There's a quote from one of the Market Wizards books by Peter Brandt, one of the traders who's interviewed in it. And it's strong opinions weakly held, which is a quote to live by if you're thinking about the idea of I'm going to analyze and I'm going to draw up my plans and I'm going to use my systems and I'm going to enter my trade. And I will have maximum conviction in that idea right up until the point where contradictory information comes in that tells me the opposite. So there are stages to this, there's parts to this, and I always find it, I probably see this more than anyone because I'm giving you guys my opinion all the time. So I get the benefit of hundreds of thousands of people seeing what I say and then they repeat it back to me. So something that's really common is I'll be bullish or bearish at whatever point, and someone who might not check the campus that much will maybe see me talking about I'm long, I want to get long, I'm bullish, I think the market's going up, and then they may not check in for a week or two, and then in the meantime I'll have closed my long or I'll have gone short or I'll have turned bearish, and then they'll come back and they'll be like confused, but Michael, you said the market was going up, and now you're saying it's going down. It doesn't make any sense. You're flip-flopping, you don't know what you're doing, or you don't understand how to trade or whatever, and you get all range of opinions and comments on this. It ranges from someone who's brand new, who hasn't never traded before or has minimal trading experience, will think that changing your mind means you don't know what you're doing. So for you as a trader yourself, you must get that out of your head. Changing your mind is exactly what you should be doing. There's a big difference between changing your mind based on facts, the data, your system, and flip-flopping, which is you're bullish because it's going up, but then it goes down a bit, so you're bearish, then it goes up again, but you're bullish again, right? Allowing the market to lead your emotions is not good. So often brand new students will think that there's something weird about how you can be bullish and then bearish in a relatively short space of time. Moving on from that, you then have people that feel like you should defend your previously held position even after you've exited it. So could be in a long or could be in a short and then close it. And maybe they still want to be long. So this is something where, like, if you are following someone and they buy a coin and then the coin goes up and then they sell the coin and you don't want to sell the coin because you didn't buy it at the same place, you will want that person to defend and almost to reiterate and reconfirm for you why you should still keep holding it, even though they've stopped holding it. So that's very common with altcoins, and especially if you find somebody who talks about a coin and it's weeks or months later, so they bought it at a much lower price, you didn't, you bought it slightly higher. So even though they've made good profits and they've exited their trade, you don't feel like you've made enough money yet on it. And so you get this inertia, so this feeling of you don't want to exit, you want to stay in, and you want them to confirm it for you. And you almost start to resent or push back against the person for the fact that they could sell that coin or close that trade. This all stems from one place. The market's all about mental flexibility. And you have to avoid flip-flopping. The way you do that is by having very clear, systematic, price action, chart-based invalidations and counter narratives. So Bitcoin goes down, it tries to break down, it stops, it goes up a bit, and then other things happen. Trump assassination attempt sends the markets higher, reclaiming key levels, moving up, better outlook than before. This new information that comes in should allow you to change your mind, but you must have a chart-based, price-based level to do that. That will allow you to say, I am bullish at this level or above, I am bearish at this level or below. And I'm trading it from an area to an area. And I'm fully aware that if price is going down, I don't care what the news is. If price is going down, it's going down. If price is going up, I don't care what the news is, is going up. Peter Brandt, back to the guy I was talking about, Peter Brandt, who was interviewed in that book, is just a chart pattern trader, like classical chart patterns. He's like 70. He's been doing it for decades. And so he will see like a rising triangle or ascending triangle or whatever, and he will see the triangle break out and he will trade. He will enter the trade. And probably one of the biggest benefits of these very simple chart pattern styles, which, by the way, he himself even says, chart patterns don't work the way they used to. 50 years ago, 40 years ago, you could genuinely just trade every chart pattern and they would work more often than not, and they actually had edge. But with the advent of computerized automated trading, it's just way too basic and way too easy for computer programs to take any of the edge and extract the edge out of that. So patterns can still work in certain instances. But what's really good about a chart pattern is that it gives you a place where you can clearly say, I'm wrong. So if you see an ascending triangle, which is where price makes higher lows, but it's a horizontal resistance. So it pushes into resistance, drops back, but a higher low, into the same resistance, drops back, but a higher low, and into the same resistance, and then boom, breaks out from that. You go long, you place your stop loss below the breakout point, and the idea of it is that I am bullish if the pattern works. And if the pattern doesn't work, that gives me an area, it gives me a really clear point at which I can first of all say, I'm no longer bullish because the bullish pattern failed, and if I so choose, I could interpret that as a bearish signal. Because a bullish pattern failing can be bearish, and a bearish pattern failing can be bullish, and I could turn the other way. Turning points, reversals, all of those things. They are typically areas where price will test multiple times. It will not perfectly bounce off the exact level you want. So if you're saying at 60k I'm bullish, below 60k I'm bearish, it might drop down to 59.5 and then back up to 61 and then back down to 59,800 and back up to 60,200. It won't go perfectly at it. So what you have to do is develop a framework to say, at this point, with this confirming factor, I'm bullish. I'm bullish until. And you can be fully convicted, and you should be fully convicted, and you should trade that with your proper size and use your proper risk management and have zero doubts about your conviction in that trade until price hits that level that gives you the confirmation to get out. And it's really important. I think that it's probably one of the most important things you can develop as a trader. It's just that idea of, I am wrong somewhere. And it's okay to be wrong, because being wrong doesn't mean that you can't make money. It doesn't mean you're a bad trader. It doesn't mean you're a bad fucking person. And in fact, if you want to think about it in terms of strong opinions weakly held, it's not that you're wrong, that you have to admit, oh, I'm wrong, I was so wrong. You're saying, my opinion is changing. Based on my system, based on the data, based on what the chart is telling me, I previously was bullish because of this factor with this invalidation. Prices went through that level, so now I'm no longer bullish. I'm either neutral or I'm bearish until price invalidates this other factor. And if you start to get used to that idea, you'll become a much better trader. You have to get better. You guys, if you're in Blue Belt, you'll know this. You have to become a perfect loser. One of the things I teach in Blue Belt is you have to get better at losing, because you're going to lose a lot as a trader. And if you can handle losses correctly, then you can survive so that the wins take care of themselves. But not moving out of that, outside of specific trades, and talking about more of a general view, because a lot of times people are like, are you bullish or are you bearish? Talking about the market. Do you think the bull market's going to continue, the bear market's? The sooner you accept that you're going to have lots of areas where you're bullish and bearish and you're going to be wrong a lot of times, it allows you to develop that flexibility. Flexibility is very simply an understanding that you can change your mind and that it's okay to change your mind. What is changing your mind? It's being wrong. Changing your mind is admitting that you were wrong. And if mental flexibility as a trader is essential, and if flexibility means changing your mind, then you must be able to become okay with being wrong. So just accept it. I am going to change my mind a lot as a trader. Over the next 10 years, I'm going to have hundreds of different times where I'm bullish, hundreds of different times where I'm bearish, on all different time frames. And it's okay. In fact, it's not just okay, it's essential. I need the mental flexibility. Mental flexibility comes from changing opinions. Changing opinions means, yes, I'm going to be wrong. That's fine. Get over it. And the sooner you get over it, the sooner you admit that you're changing your mind, the sooner you get that monkey off your back about the whole ego thing about being right. You're not here to be right. You're here to make money.